I still remember when I placed my first trade with $20 5 years ago. I grew a $20 account to $168 in one day. I then went on to lose the money, but the experience that I've learned in that time is something that kept me going until I am where I am right now, 5 years later. In this video, I'm going to show you how to start trading with $10. But before we get started, let's talk about, is $10 enough for you to make a living as a trader? The answer is no. But if you have $10 to put in the market, you can use that $10 for learning purposes, because what is the point of risking thousands of dollars if you're a beginner trader and if you don't know what you are doing? If you can just risk $10 and learn the game and how it works, and then you scale up from $10 to 100 to 1,000 to 10,000 up to 100,000 or millions of dollars. Because what happens most of the time is most people will start learning on a demo account, which is fine, but I think a demo account is not good enough for you to learn the game, because in demo account there are no emotions involved. You're just placing the trade and you know that the money that you are risking is not yours, so emotions doesn't come into play. But if you have $10 and you put $10 in the market, at least you have some emotions going on and you can see how your mind reacts to different market movements and behaviors. I'm gonna show you a step-by-step guide of what I can do if I want to trade this $10 and if I want to grow it and learn at the same time. So the first step, if you have $10 in your account, is to go to the 5-minute time frame. And why the 5-minute time frame? Well, if we go into the market and if we pull the ATR indicator, you are going to see that if the market is in a 5-minute time frame, the ATR shows you that the market moves on average 8 to 15 pips on a 5-minute time frame. And if you don't know what the ATR indicator is, an ATR indicator is an indicator that shows you the average pip movement of the market in any given time frame. So if you go to the 5-minute time frame, the ATR is going to show you the average is 8 to 15 pips, which means the market moves around 8 to 15 pips per each and every 14 candles. So as a trader, you want to be able to catch or risk 10 pips to 15 pips per trade if you only have $10 in your account. And why 10 to 15 pips? It is because if you use the minimum lot size for any currency pair, which is 0.01, which is the micro lot, you can be able to risk 10 cents per pip, and for 10 pips is gonna be a total of $1. So each and every one of your trades is going to be risking $1. Once you risk $1 on each and every trade, that means you are going to be able to make $2, $3, $4 per trade, depending on your risk to reward ratio, and we are going to talk about that in a minute. Now, once you go to the 5-minute time frame and you are risking 10 to 15 pips per trade, risking $1 to $1.50 per trade, the next thing is you want to know exactly when are you going to place the trade. What are the setups that you are going to use on that? Now, to know the setups, you need a strategy. And a strategy is none other than a set of rules that you want to meet before you place your trade. You want to make sure that you want to see certain things lining up and before you place the trade. For your strategy, you want to use something called the TAE. And what does the TAE mean? The TAE means you want to first see the trend of the market. Is the market moving up? Is it moving in a sideways, or is moving in a downtrend? Or the T means you want to identify the trend first. What is the trend of the market? Is the market moving to the upside? Is the market moving to the downside? Or is the market moving to the sideways side? If you don't know anything about the trends and how to analyze the market, I will leave a free course in the description below. But once you know the trend, the next step is to know the area of value. What is the area of value? It is things like support and resistance. It is things like Bollinger Bands, knowing where the market is likely to reverse on. So that's the area of value. So let's say you see the market in an uptrend and then it reaches a support level which might make the market bounce to the upside. And then the next thing you want to see is the entry trigger. The entry trigger is something which can be a candlestick pattern, anything that shows you that the market will likely move to this direction. I will show you an example of this strategy in a moment, but I want also to talk about your exit. Now, your exit on this strategy is you want to put your stop loss 10 pips away from your entry, or 10 to 15 pips. Why 10 to 15 pips? Because it is the average price movement of the market. That's the range that if the market goes in your direction with that, you can know that, okay, maybe the market is moving in a different direction from where I want it to. So you use what is called the ATR indicator. Right, so now before we move on to step 3, let me show you a step-by-step strategy and the actual trade that I'm going to place on this $10 account that I deposited right on this video. So let me show you that strategy step by step.
Okay, so right now I'm going to show you an example of the simple strategy that you can use. So this simple strategy uses 3 concepts. As I said, the TAE means the trend, the area of value, and the entry triggers, right? So first of all, you want to see what is called a 1 2 3 move. And what is a 1 2 3 move? It is a move which looks like this. You see an impulsive move which is going down, or it might be going up. So this example is for a downtrend. So once you see this impulsive move, you see a pullback, and you see another impulsive move which looks like this. So we have this one here, we have this 2 here, and we have this 3 here. This is what is called a 1 2 3 move. So what do you do at this point is you want to mark out this zone right here. So if I mark out this zone, you are going to see that I'm going to come up with a zone which looks like this. So if I mark out this zone, the next step that I want to do is I want to wait for the market to come back into this zone right here. So once I have something like this, I will be able to place a sell trade right here. So at this point, what I would do here is I would go ahead and sell right here, and then what I will do is I will put my stop loss above this zone right here, which is my stop loss. But we are going to talk about the stop loss later on, and then we expect price to move to the downside because this is a trend continuation trade. And you might be thinking, okay, maybe this doesn't happen, maybe you never see something like this in the market. But let me show you a good example, which is the market that I'm about to place my trade right here right now. So you can see that this market have been moving to the downside like this, and then you can see our 1 2 3 move is very clear right here. You can see the market have been moving to the downside here. It pulls back, it creates a move to the downside again, giving a 1 2 3 move, and now we are on that zone here. So I'm expecting to sell here and then prices to go to the downside. So
now that you saw the strategy, step number 3 is knowing your take profits. You can realize that when I talked about the strategy, I talked about the entry and I talked about the stop loss, but I didn't talk about the take profit. Why I didn't talk about the take profit? Because if you have a $10 account, your take profit is going to be different from someone who is trading a very big account. As a $10 trader, you want to make sure that your trades, if you make money, you want to make as much money as possible. So you don't want to have a fixed take profit. You just want to make sure that you take profit when you get like 3 times or 4 times the risk. Why am I saying this? Because this is a small account, and if you want to grow a small account, there's no better way to grow a small account than using big risk to reward ratio. So for the take profit, you want to make sure that you make like 3 times the risk. So if you risk 10 pips, you want to make 20 pips, 30 pips, 40 pips, which is like 2, 3, 4 or 5 times your risk. And remember, you have $10 and you are risking $1 per trade with 10 pips. That means you have 10 chances to flip that account. So every one of the chance that you get for the market to go to your take profit, you want that chance to make 2, 3 or 4 times your risk. Right, so you want to make sure that you get as much money as possible. For me personally, I don't place a take profit on a small account, but what I do is I just want to make sure that I make more than the risk, and then I will realize if I need to take profit or not. But I just want to make sure that each and every take profit, each and every trade that I close in profit is very much bigger than the loss that I placed. Now, step number 4 is to analyze your trades after each and every 10 trades. So after 10 trades, you will find out that if you lose all 10 trades, you are going to lose your entire $10, which is totally okay. $10 is not a lot of money, but I'm not saying you need to lose, but also it's not something that you can cry foul on, right? But then if you don't lose those 10 trades in a row, there's 2 things or 3 things that will likely happen. Number 1, you will find out that most of the time you will take your profits too early. Most people will fall into the category of people who take profits at 20 cents, 30 cents, 40 cents. Why? Because they fear losing that $10. But I want to tell you that if you're trading only $10 and you fear losing $10, maybe you are not ready to trade, because $10 is a very small amount of money, especially in the forex market. So you want to stick to your plan, and then you want to make sure that if you lose that $10, you take that 10 losses and learn from those 10 losses. There's 3 things that you are likely to learn. Number 1, you learn that most of the time when the trade was in profit, you could have taken profits too early, taking like 20 cents, 11 cents, 40 cents, 60 cents profits, right? Thinking that maybe if I take these small profits, I can cover up the losses that I got. But unfortunately, it doesn't happen like that. Number 2, you might find out that you might be changing your stop loss and accommodating more risk than you wanted in the first place. What I mean by this is you will find out that most people, when you are in loss, you don't want to lose that dollar. You move the stop loss down and accommodate more loss, thinking that the market will reverse, but at the end of the day, the market doesn't reverse and you lose money. And number 3, you might find out that you will change the strategy after losing like 2 to 3 trades. So as I said, before you place these trades, you need to know which setups are you going to be using. But you find out that for most people, what happens is when you lose like 2-3 trades, you start thinking about changing the strategy using something else, and this is a big disaster, which sometimes I get into. But then I will remember that if I want to become consistent, if I want to stay making profits in the market, then I need to follow my back-tested strategies, right? Now, step number 5 is learn from this experience and repeat. So if you find yourself making these mistakes, maybe you might need some help. I will leave a link in the description. There's a free course, and also we have a 30-day training program that you can join. I will leave all the links in the description. But then let's move on to step number 5, which is increasing your capital and increasing your risk. So as you learn, if you blow this $10 account, do not increase. But then let's say you take this account maybe to $20 to $30, and you can consistently do this for like 4, 5, 6 times, right? You can then now move on and increase your capital and start trading bigger accounts. Because to be honest with you, trying to grow $10 account to $1,000 or more is very, very hard. But what I can tell you is that you need to compound this money. Let's say you trade this $10 to 20, and then maybe from your income from any side hustle that you are doing, you find another $20, you find another $50. You need to edit that money into this account and now compound it, and now use the same concept that we were using on a small account on a bigger account, and you grow and you keep doing the same thing over and over until you grow your account to 500, 600, 1,000, and then from there you can take bigger risk, you can make bigger profits. And that's for a disclaimer, I'm using these numbers because numbers like 1,000, 2,000, 3,000 are big enough for you to trade for a long time if you are living in low income countries like I do. I'm from Africa, and I know that if you have 2,000, 3,000, 4,000, 5,000, you have money in Africa. But then if you are watching this from Europe, USA, and all other rich countries, that means this is still a small account to have $5,000. But if you are living in Africa, I think $5,000 is a big account. So what I mean by this is, when you add these accounts, when you add on this money into your accounts, you end up having a bigger account where you can take bigger risk, where you can make bigger profits. But then the crucial thing is learning how the grind goes. And learning how the grind goes start off by you depositing $10, risking 10 cents per pip, for risking $1 and doing the same thing over and over and over and over again until you find your perfect strategy, until you are able to control your emotions if trades are not going in your direction, until you are able to see your strategy on one click. When you look at on your screen, you exactly see what the strategy does and how it's performing, right? So this is how you start trading with $10. For me personally, this $10 that I deposited in the account, I'm gonna journal all this journey as we move forward. Right now I'm trading another account which is like $20 in, and I have lost almost half of that account at that point. I lost 4 trades in a row with that account, but I'm still looking to grow it, and I'm recording each and every progress. I will drop that video in a few days. Make sure you click the subscribe button and let me know what you think about this video. If you like it, hit the like button, and if you don't, hit the dislike button, and I'll see you in the next video.